You're ready to buy your first investment property, but there's that one nightmare scenario, right? Buying a hidden money pit that just bleeds your bank account dry month after month. Well, what if I told you there's a simple, non-negotiable checklist that separates the winning deals from total financial disasters? Stick around because we are going to break it down step by step. So, you've made the call. You're going to jump into real estate investing. And you know what? That is a huge step toward building some serious wealth. But that initial excitement, it can turn into analysis paralysis really fast. And this is exactly why. This fear of buying the wrong house, it's the #1 thing that keeps so many would-be investors sitting on the sidelines for years. But here's the thing. That fear is completely manageable. You can pretty much eliminate it by following a simple, logical framework.
We call it the go/no-go gauntlet. Think of it like a series of checkpoints or gates that any potential property has to pass through. If it fails even one of those gates, it's a no-go. You walk away, no emotion involved. It's really that simple.
So what does this gauntlet look like? Well, first, we're going to start with you, with a hard check-in on your own finances. Then we'll pick a smart strategy and a good area. After that, and this is the big one, we'll run the numbers to see if a deal actually makes sense. Then we'll check the property for any of those money pit red flags. And finally, we'll bring it all together for that ultimate go or no-go decision.
All right, first things first. Before you even think about opening a real estate app, the very first gate is taking a hard look in the financial mirror. This has nothing to do with the property. This is all about you. To get the best interest rates from lenders, which, believe me, dramatically impacts your monthly costs, you really want to be aiming for a credit score of at least 680. If you're not there yet, guess what? That's your first mission. Next up is cash. Look, for a standard investment property loan, you're not putting 3% down like on your first home. Lenders, they want to see more skin in the game. You're typically going to need somewhere between 15 and 20% of the purchase price for that down payment.
And this is the one everybody forgets. After your down payment, after all your closing costs are paid, you absolutely must have an emergency fund left over. A bare minimum of $10,000 is a really good starting point for that what-if fund. Because what-ifs always happen.
So here's the bottom line for Gate 1. Financial stability is the bedrock of this whole thing. If buying a property would leave you with zero cash reserves, it has failed the first test. It's an automatic no-go, and you haven't even looked at a single house yet.
Okay, so you've passed Gate 1, your finances are solid, awesome. Now we can actually start thinking about the property itself. So the next gate is all about strategy. What kind of property are you looking for? And just as important, where? For your first deal, please keep it simple. Your goal is stable, predictable monthly income. That means you should be focusing on things like a house hack, where you live in one part and rent out the others, or just a standard buy and hold rental. You want to avoid the high-risk, high-stress strategies like flipping or short-term rentals for now. Those can come later, I promise.
Now, picking a location, it doesn't require a master's degree in economics. Just look for the basics. Is it near major employers, stores, highways? Is there obvious rental demand when you look at places like Zillow or Facebook Marketplace? And here's my favorite test. It's simple, but it's so effective. Drive through the neighborhood at night. If you don't feel safe getting out of your car, your ideal tenants won't either. It's really that simple.
All right, listen up. This is probably the most important gate, and it's where most beginners get into a world of trouble. They fall in love with a house and just hope the numbers work out. Let me be clear. Hope is not a strategy. It's time to run the actual numbers.
Before you do a deep dive and waste a ton of time, use this quick filter. It's called the 1% rule. It's just a back-of-the-napkin test to see if a property even has the potential to make you money. The goal is for the monthly rent to be at least 1% of the purchase price. So a $250,000 house should rent for around $2,500 a month to be a really strong contender. Now, it's not a law of physics, but if a property is way off this mark, that's a huge red flag that the numbers are going to be really tough.
Okay, let's look at a real-world example. We've got a $250,000 house that rents for $2,100 a month. Now, on the surface, bringing in over $2,000 a month, that sounds pretty good, right? But this is where new investors get absolutely burned. They forget about the hidden costs. So after the mortgage, taxes, and insurance, you have to account for maintenance and vacancy. And these aren't just suggestions, they are inevitable costs. We use 8% of the rent for maintenance, for the new water heater, the leaky faucet, and 5% for vacancy, because no property stays rented 365 days a year, forever. And when you account for reality, look what happens. This asset is actually costing you $158 every single month out of your own pocket.
This is a non-negotiable no-go, period. You are not buying a second job or a liability. You are buying an asset. If the property doesn't put money in your pocket after all the real-world expenses are accounted for, you walk away. No exceptions.
So the numbers work on paper. Fantastic. But a spreadsheet can't tell you if the foundation is cracked. The fourth gate is a physical check to make sure your cash-flowing asset isn't actually a hidden money pit just waiting to happen.
Your first property should be boring. Seriously. We want stable and boring. We're not looking for a massive renovation project. You're on the hunt for deal-killer red flags. I'm talking about a bad roof, big water stains on the ceiling, ancient wiring, or any signs of major structural problems. If it needs tens of thousands of dollars in repairs right out of the gate, just skip it. Let someone else take on that headache.
Okay, a property has made it this far. You can afford it, the number is actually cash flow, it's in a good area, and it's in decent physical shape. It is time for the final checkpoint before you even think about making an offer.
So this is it, the entire gauntlet, the whole process. It comes down to this simple formula. A property only gets the green light if it meets these 4 conditions. Number 1, you can afford it comfortably. 2, it generates at least $200 a month in positive cash flow. 3, it's in a decent rentable area. And 4, it doesn't need a huge cash infusion for repairs right away. If you can check all 4 of these boxes, you've got yourself a winner.
I want you to remember this. Burn this into your brain. Success in real estate is not about timing the market or hoping the property value goes up in 10 years. Your success is locked in the day you close the deal. Buying the right property at the right price with the right numbers from day one is how you win this game.
And finally, just let go of the pressure to find the perfect deal. Your first property is not about hitting a grand slam. It's about getting on base with a safe, manageable asset that pays you every single month. Because once you're in the game, the real question isn't, how do I find one perfect deal? It's, how many of these solid deals can I stack up over the next decade?
This is the Brick by Brick channel, where we help beginners build wealth through real estate one brick at a time.
If you got value from this, do us a favor and hit that like and subscribe button for weekly investor breakdowns just like this one. We'll see you on the next one.